Good morning and welcome to the Killik & Co market update. It's been a really interesting week for markets with some pretty big moves. A lot of these moves took place across European markets after Germany said it is looking to relax its so-called debt brake. Germany is part of a group of nations that are sometimes referred to as the frugals on account of their cautious approach to debt. Back in 2009, Chancellor Merkel introduced a rule that said government borrowing cannot exceed 0.35% of GDP on an annual basis. As a result, Germany has far less debt than other larger economies. On this chart, we're showing the debt to GDP ratios for Germany, the US, and the UK over the last 20 years. Germany is shown by the black line. You can see how the ratio has declined substantially since 2009. Germany's ratio is currently just over 60%. The US and the UK have much higher ratios. The UK's is around 100%, and the US has a ratio above 120%. You can see that the debt level for all three countries increased as a result of the financial crisis in 2008 and the pandemic in 2020. Germany's relatively low level of debt has meant that investors have been more comfortable lending to Germany in recent years, and therefore Germany hasn't had to pay as much interest on its government debt. On here we're showing 10-year government bond yields for the three countries over the last 20 years. Germany, again the black line, has been much lower than the others for most of this time period. It's even spent several years in negative territory. The German 10-year government bond yield is less than 3%, whereas the yields for the UK and the US are over 4%. This week, Germany has said it is looking to lift its debt brake, but only in relation to defence spending. This, in theory, means that Germany could borrow an unlimited amount of money to spend on defence. In addition to this, the country has said it is looking to set up a new infrastructure fund worth 500 billion euros. These announcements led to a rise in German government bond yields. Here's a close-up of how the yield has moved over the last year. You can see the big spike this week, although it's still below 3%. And on the day of the announcement about the infrastructure fund, we also saw some significant increases in European infrastructure and defence companies. Heidelberg Cement was up 17.5% in just one day. Chemicals company BASF was up 10.7%. Sika, a Swiss chemicals company, up 7.9%. And finally, German defence company Rheinmetall was up 7.2%. So please do give us a call if you'd like to talk about these market moves in a bit more detail. Over in the US, meanwhile, we've seen a bit of weakness in markets this week. Here's the S&P 500 over the last 12 months, and you can see that decline since mid-February. It appears that markets are getting a bit nervy about the constant changes to the tariff situation in the US. Tariffs are constantly being threatened and then revoked, so it's really difficult to know what's going to happen and therefore to make a plan. Earlier this week, Trump went ahead and imposed tariffs on Canada and Mexico, but since then he has issued two further updates exempting various products from these tariffs. One of these was that car makers will be granted a 1-month reprieve from tariffs. Car makers are believed to be one of the sectors that will be worst impacted by tariffs. Here are the share prices of Ford and General Motors over the last 6 months. Just look at the declines that have happened since November when Trump won the election. This tariff situation is literally changing on a daily basis, so we'll be monitoring things closely and we'll keep you updated of any major developments. And lastly this week, the latest FTSE 100 quarterly reshuffle has been announced. This quarter, Coca-Cola Euro-Pacific Partners is being promoted into the FTSE 100 index after a strong share price performance, and British Land is being relegated to the FTSE 250. Coca-Cola Euro-Pacific Partners is the bottling business for Coca-Cola. British Land is a real estate investment trust investing in various types of property. Here's the 10-year share price chart. It's been a very difficult few years for property. Retail property has struggled as shopping has moved online, and offices really struggled in COVID. And then everything has really struggled a bit since interest rates started rising in 2021. So you can really see why the share price of British Land has come down. Moving on to have a look at next week, it's looking fairly quiet on the corporate calendar, and there are no companies on the Killik covered list scheduled to report. So have a great weekend, and we look forward to seeing you next Friday.